Welcome investors to the 40 Finance channel. My name is Jeff Beers. Today I'm going to share with you my investing strategy, the sort of high-level investing strategy here for 2021. If you've been watching the channel for a while, you'll know that since January, late December, I've been taking what I would consider to be a lot more risk in the stock market. Now those risks are all calculated, and I do a ton of due diligence in the stocks that I invest in, and I always try to make sure that I'm diversified and the stocks that I really like and believe in have outsized holdings compared to the ones that are riskier. And the biggest reason I'm making a minor shift to my strategy is, I had a good year last year. It was plus 39%. In my eyes, though, it probably should have been more like plus 50, plus 55%, something like that, when you take into account some of the obvious plays that I missed. So in addition to the S&P 500, which I was able to beat last year, I am gunning for the QQQ this year to outperform that. It's a favorite ETF of mine, a big holding in my ETF retirement portfolio. And generally speaking, it is a formidable candidate with the top 100 market cap weighted stocks of the NASDAQ. So we'll dig into my strategy for 2021. I'll show you how it stacks up in my portfolio. And I'll talk a little bit about how I see future additions coming along. Reminder, as always, in my stock picks and projections, they're just my opinion for your entertainment. Please make sure you do your own research before investing in any stock. And if you like stock market analysis like this and other personal finance videos, please give this video a like, subscribe to the channel. Thanks to everyone for your support. All right, so the strategy here for 2021 for my portfolio is a barbell investment strategy. And I'm tweaking it here. It's not going to be apples to apples per this definition. But if you've been in investing for a little while, you've likely heard analysts on TV and stuff talk about a barbell strategy. And the short version is you're trying to invest in two extremes of high risk and no risk assets. Now, in a standard barbell strategy, you would take it pretty far to the extreme in the sense that the low risk or, as they say, no risk assets would likely be treasuries, bonds, things like that, sort of guaranteed income at a nominal rate. And then on the high risk side, you would actually be taking on as much risk basically as you could stomach to try to take, full advantage for whatever is going up in the market today. All right, so from my side of the coin, like I said, I made some tweaks to this model. For starters, I don't invest in bonds, and I really don't have any interest in investing in bonds. If the world changes down the road with interest rates and stuff, then maybe I get mildly interested. But for the most part, I've always been 100% stocks, and I likely will be for some time. Now, for my barbell strategy, I am splitting things up into their own baskets of risk, high risk and low risk, but I'm making that determination myself based on my familiarity with the stock, how their sort of fundamentals and balance sheet looks, and where I think they can go realistically in the future. All right, so now let's take a look at the buckets that I've put my stocks into as of today in February, and I'll let you know my thoughts behind each one, and we'll look at how the performance has been in the sort of low risk versus high risk baskets. Okay, so here is the low risk side of my barbell strategy. You've got Amazon, PayPal, TAP, TJX, TSM, and Visa. Now, each of these stocks, in my opinion, have only so far down that they would ever fall. So it doesn't mean I would never lose money necessarily on these stocks, or that they wouldn't go down, I should say. But from my perspective, the risk levels here on these stocks compared to where I bought in at and where the world is going is very low. Certainly we might see some unexpected events and a poor quarterly earnings here and there. TAP just posted one yesterday. But when the world gets back to normal, I feel pretty good that these companies are going to be just fine in the long run. Now, when you look at my investments with them, I have put in $37,000 with these stocks. Right now, they are worth $50,000. Now, when you look at the investments I've put into these stocks, I have put in $37,000, and they are currently worth $50,000. And this is over the past couple years or so since I've moved to Ally Investments. But some stocks like TJX and TAP I've held for much longer. But long story short, you've got a gain there of about $13,000. All right, and this is the basket of high risk, if you will. I know that this font's a little small. We'll go quickly. BFT, which is the SPAC for PaySafe. DraftKings, Enphase, Etsy, GBTC, which is the Bitcoin Trust, Rocket, Sabre, SDC, Smile Direct, Square, Unity Software. And at the bottom here, you've got $35,000 invested, and you have $50,000 for the return. Okay, so in my low risk side, if you will, I have put in $37,000 for a return of $50,000. And on the higher risk side, I've put in $35,000, give or take, for a return of $50,000 as well. Now, keep in mind that some of the stuff I have in the low risk side of the barbell, I've had for a couple years now, whereas most of the things on the higher risk side of the barbell are all recent acquisitions over the past year or so. In fact, as I look down the names here, you know, the oldest acquisition on that board is the Bitcoin Trust, which I bought about 3 years ago. The rest of that side of the barbell is all new acquisitions, and things could change over time. Now, the adjustment with this barbell strategy can come as I start to feel better about a stock. Square's a really good example. I have it on the high risk side right now, but that's because I just got in at like 214, and you know, like a week later, the stock went up to $260. So I can still see some volatility in Square that would bring me to a net loss. It doesn't mean that the stock's going to go out of business, but I could easily run into a net loss on Square in the short term. But as time goes on, as the company continues to make money and improve their EPS, there'll be a day that I can move that basket over to the low risk side. And when that day does happen, I'll essentially open up more opportunity to play with risk on the high risk side, right? So just pretend that I have $5,000 in Square to make it easy. And I get to this point where, in my opinion, Square is a low risk asset. Then I would move it over to the low risk side of the barbell. Then that opens up. I added $5,000 to the low risk side, and if I'm keeping it balanced, that means there's $5,000 open on the high risk side for when I find a stock that I think is worth trying out. Now, for me right now, I decided to go by cost basis only. So I want to invest an even amount in what I would consider low risk and high risk. A lot of that is because of where we're at in the market right now, and with money flowing everywhere. I think we can afford to take more risk in 2021 only because the valuations of every stock are up just a little bit. The bigger key probably for me is just making sure that the companies that I choose, regardless of the risk profile, do I believe that they'll be in business 10 years from now? That's one standard I'm still holding myself to. So that's how I'm approaching 2021. I want 50% of my investments to be in what I would consider safer stocks, or stocks that I believe are not going to go down dramatically. Yes, we might have market downturn, market crash, something like that. But for their fundamentals of their business and their balance sheet, I don't think that I would see any problems with the companies that are in my low risk basket. Now, on the high risk side, listen, I'm still doing my due diligence, but like I showed you with Unity Software yesterday, that's a company, you know, no EPS, every fundamental is basically high and or negative. But I do believe the company has potential, and it came back a little bit, and it was just an attractive play. It just resonated very well for me, so I went ahead and bought it. but that does count against the high risk side of my barbell. So let's just pretend I went crazy and bought $10,000 worth of Unity, which I didn't. Then I would have to eventually come back and put another 10,000 on the lower risk side, likely by investing in those companies that already exist there. All right, guys, I hope this makes sense on my investing strategy here for 2021. When we get to 22 and 23, every year, I will probably be using a barbell-esque approach, but depending on what the risk-reward outlook is for the year, the risk side, it may not be a 50-50 split. I may go down to a 30% split on the risk side. But definitely for 2021, I'm going 50-50, and I feel like that gives me enough opportunity to take advantage of some of the things that I have witnessed over the past year in stocks that I wanted to buy in that just didn't fit my standard valuation profile. All right, guys, hope this helps. Let me know how you're approaching investing in 2021. We'll see you on the next video.